Hello, everyone. This is Connor Darrell from the Wealthspire Investment Team, and welcome to our September 2025 Markets in 2 Minutes. We hope that everyone had a great summer. So, for those of you who had the luxury of stepping away and not thinking about financial markets during the summer, we are planning today to provide an update on the performance of small cap equities over the summer months, because there's been some interesting developments in that space, which we think are important for investors to be aware of and to help put some perspective around that recent performance. So, for much of the past several years, it was large cap stocks that were kind of dominating the markets in terms of performance, but that flipped a bit this summer, and small cap stocks actually outperformed by a fairly wide margin. And you can see here on this table that the Russell 2000, a commonly cited small cap index, generated a 15% gain during the period from June through August. And then looking under the hood even further, you can see that telecom stocks in particular experienced an exceptionally strong rally during that time. And basically what happened is that we got a flurry of economic data over this period, which indicated to markets that the Federal Reserve was finally going to be in position to cut interest rates. And for small cap stocks and small cap telecom stocks in particular, these are companies that tend to run with more leverage on their balance sheets. And so the prospect of lower rates leading to lower interest costs was a real benefit for the stock. Now, one of the interesting things to keep in mind when it comes to small cap stocks, though, is that not every index is created equally. So obviously, we're showing Russell 2000 data here, but there are a lot of different ways to parse the small and mid cap universe into investable indices, or baskets of stocks, if you will. And from an investment perspective, we actually have a preference for the S&P suite of indexes, and those would be the S&P Mid Cap 400 and the S&P Small Cap 600. And the reason for that is that those indices employ a profitability screen when determining eligibility for index inclusion, which means that as an investor, you're getting exposure only to stocks that are generating profits, or at least were generating profits in recent periods. And you can see the difference between these indices when you look at this chart here. With the Russell 2000, almost 1/3 of those stocks are losing money, whereas those fractions are much smaller when you look at the S&P indices represented by those two blue lines on the chart. And the reason this is important is that over the long term, companies need to produce profits in order to generate real value for shareholders. There can certainly be periods where unprofitable businesses and long-term growth prospects look favorable, and the market may put them in high regard, but it's important to always circle back to fundamentals, and that's where index construction matters. And so, in our view, investors should be thoughtful about how they invest in small and mid-cap stocks and avoid chasing what many people might refer to as a junk rally, where some of the lower quality companies in the index are leading things higher. It's during periods like this that we stress the importance of discipline and a thoughtful approach to portfolio design. And this is just one example of the nuance that comes into play when determining how best to gain access to different markets. And so with that, I will wrap things up for this month's update, and we'll plan to return in October with some more perspectives. Thanks for listening.